Hello everyone, welcome back to my channel. So this video marks the end of week number 48 in this 100k realized return challenge, and the week was a very positive one for the markets, a cascade of favorable news and also combined with some hopes when it comes to the potential interest rate cut by the Fed. So the ceasefire between Israel and Iran, there was a combination of developments that led the market to grow to new heights, and they reached new all-time highs. However, due to those circumstances, we were not able to capitalize on almost all of this appreciation. And if you recall, we sold 3 call options on the QQQ on Monday, but as you recall my explanation, the calls expiring the same day, the 0DT options with a strike price of 535 at the time, were only being quoted at 2 cents a piece, which is basically almost nothing. And that is the reason why we decided to go ahead and sell a 2-day option, a 2-day call option. However, given the situation, it turned out to be that this was a very, very bad choice. And why is that? Not because at the time it was a bad decision. It seemed quite logical, but nobody can predict the market, what's going to come in the next day, the next 2 days. And so basically this is what happened. From very early on, the position was at a loss. Even so, it ended the day at around 531, 532. And so right from the get-go on Tuesday, the stock made a jump past our strike price. And by that point onwards, there was nothing we can do unless we realize another loss of about 1,500 or 2,000 dollars. We would realize a loss so that we could keep the shares, because this loss would entail that we would buy back the calls that we sold at a much lower premium. And so we decided to let it go, and the shares were sold at the price we bought them, 535. We were not able to, as you can imagine, to get back all the money, all the funds that we lost. So with all combined, we still had a loss altogether, counting the premiums, of $3,210. So we had the overall of $9,484 dollar loss, but with the premiums we got about 6,273. So overall the loss was 3,248, which is accounted right here somewhere. Yeah, this is the one we accounted for. And at the time, it was my expectation, or that it could be possible that the stock would have a pullback given this large gap, so that we can then sell puts. Because keep in mind, we cannot buy or sell these shares directly, because we are based in Europe, and only in the United States you are allowed to buy or sell these shares directly. The only way you can get exposure is by selling options, and if the options are assigned, you are forced to buy them, and so that's how you keep it in your portfolio. And in the same way, the only way to sell them, you cannot sell them directly. The only way to sell them is by selling calls, and so you are assigned, and by that way you will get rid of the shares. Of course, if you can also buy if you exercise long calls, and you can also sell if you exercise long puts, but this is the way that we are currently able to buy and sell these shares. However, at the time, this was my aspiration or expectation that this could happen. However, it happened anything but. The stock continued to climb, even though here it was a little bit of a off-color day on Wednesday, but from Thursday onwards the stock continued to rise, and the same thing on Friday. and it reached a point in which if we had maintained the stock, we would have recovered completely our loss, because our break-even was around 546 at the time. But yeah, we basically were not able to capitalize on this. Even so, on all of these days we sold puts on the shares. So this is where we are at the moment, and after we sold the shares here, we sold 3 puts on the QQQ with this outcome. So these were always gains above 100 euros, $100, and yeah, basically we managed to get some premium out of these, but still it pales in comparison with the gains we would have had if we kept the shares. Yeah, these are situations that you cannot really predict, especially as you are approaching all-time highs. Keep in mind that the previous all-time high was around 540, and so I would think that after you reach all-time high, the stock would somehow get some more resistance from there, you see. However, yeah, basically the stock over this week bursted through the all-time high and reached new levels, new records, new all-time high. And so we are running in a more riskier situation, because we are forced to, as you can see here, continuously raise our strike price for the puts that we sell. And honestly, I'm not very comfortable in being assigned at such a high price, because if you have a pullback, and of course the more the stock rises, the more likely you'll get a pullback, and a more violent pullback, and so you are forced to keep shares bought at a very high price, and then you are forced to go into the same type of trading that we have been doing since all this instability regarding tariffs and all that took place, which is basically try to sell calls with the strike price below our cost of acquisition, and then you have to put stop losses in all your trades, because you don't want to have the risk of having another large loss like we had before. And that means that on every large move intraday, you are very likely to trigger your stop losses, and you have a loss instead of a small win. Yeah, and so we really want to avoid that, and that is the reason why at this moment in time, and after doing some reflection about what we are going to do next week, I'm considering very strongly the possibility of not selling more calls, selling more puts on the QQQ. And keep in mind that the QQQ shares are very expensive. In order for you to have selling a put, you need to put up almost $55,000 in collateral to cover the potential of the puts being assigned to you, and you're forced to buy them. And so if you are assigned the 3 puts, you have very little wiggle room to get more money. Even if you deposit more money, it's very difficult for you to get enough money. In that case, another $55,000 or $53,000 or 51 if the stock continues to pull back, in order to lower your cost basis. And so that is the reason why I'm seriously considering, given the options that we have available for 0 DTE, the only ETFs that sell 0 DTE options are the IWM, which tracks the Russell 2000, which is the small cap index, the QQQ, which tracks the Nasdaq 100, and the SPY, which tracks the S&P 500. However, the S&P 500, as you can see, it's even more expensive. Each share is more expensive than the QQQ, and so for me, this is completely off the table. I'm not going to sell puts on this, because that makes even more difficult. And we don't have, by the way, enough funds to buy 3 contracts on the SPY. So my feeling is that we are going to try to do something different, and that means sell options on the IWM. We have to keep in mind that this is a slightly more volatile ETF, because as you can imagine, we are talking about small capitalization companies. But if you look at the graph, you'll see that of course it has a more erratic behavior, a lot more gaps, but the gaps we can somehow manage it. We can somehow stay reasonably protected from those, because those gaps are mostly from one day to the next. And so if we trade 0DT options, we are no longer exposed to that risk, which depends only if you only are exposed to if you keep positions open overnight. And so this is why I'm strongly considering to sell some puts on IWM. Also, if you see here, we are still quite some way off the all-time highs, and that means that we still have some room for the stock to continue to grow, especially now if the Fed goes ahead and lowers interest rates, the small caps, because they are more dependent on financing from banks and less from the stock market because of their small capitalization. They are more sensitive to interest rate changes, and so the interest rate cuts should play a bigger role in bringing, or should have a bigger effect in bringing the stocks up and the market continuing to rise. And so because of all these factors, the fact that we are not yet close to an all-time high, the potential for interest rates cuts in the coming months, and also because the stock is much cheaper in price, I think it makes sense for us to shift our focus from the QQQ while it remains beating records and stay at these historically high levels, and go for the IWM. It's a bit more volatile, but that also means that we will get more return out of it. All right, and so as you can see, you have a 0DT options on the option chain, and that means that we will be able to continue to do our strategy of selling options every single day without being exposed to overnight risk. And of course, because of the high volatility, we are going still to pursue a quite conservative strategy, and that means trying to sell puts with a very low delta, which means basically with a high probability of profit, because if they have a low delta, the probability of expiring worthless is very high, because the delta is also a measure of the likelihood the options expire with value in the money, and we want the options to expire basically out of the money. And so this is something that we are probably going to do, because we really don't want to get hung up with shares of QQQ at near all-time highs, and then we have to resort to another series of trades with selling calls below our cost of acquisition. And yeah, I think this is probably the way to go for the next few days, or probably even weeks, and wait and see what happens. It's likely that it's possible, not likely, but possible that the QQQ continues to go higher and higher. But if that happens, basically we'll have to wait for a pullback before shifting our focus again to the QQQ. Personally, I prefer to invest in the QQQ and have options. If you ask me between holding shares of QQQ or holding shares of IWM, the QQQ is far better, but given the current market conditions, I think it makes sense for us to shift focus and go for the IWM. Even if we are assigned, the pullback should not be as extreme as in the QQQ because of the all-time highs, and also it's easier for us to buy or to sell more puts on the IWM tool, and if we are assigned, we are able to lower our cost basis much quicker because the stock is much lower in price. And so yeah, this is most likely the way we are going to proceed. Now we have also this elephant in the room, Pfizer, and this was quite concerning to me this week because, as you can see here, the week was a very positive week. S&P and the Nasdaq broke through their previous all-time highs, and they reached, of course, new records. And even so, Pfizer still remained trading in this over this range between 24.10 and 24.40. So it never got even close, or it got close, but it didn't even approach or touch the 24.50 barrier, which is, as you can see here looking at the graph, some sort of the resistance that we have to surpass in order to be able to sell our stocks breaking even. And so this is very concerning. This is becoming a very big drag in our performance, in the performance of our portfolio. And honestly, I'm really at a loss, on what should be done, because of course we are going to continue to sell more puts on it, try to lower our average price the best we can, but it's getting very difficult, very difficult to sell these shares, because the shares are not volatile. They don't have any volatility at all at the moment, and it's becoming very concerning that how are we going to get rid of this, because we need some volatility to be able either to buy more shares, lower our cost basis, or to be able to sell them at least breaking even. If the stock doesn't move, there's nothing we can do about it. And so, this is compounded, this problem is compounded even more by this option chain that you can see. This is the option chain expiring next week, and the premiums are even for the 25, which is at our target price for the call options, it's still at a loss, but at least we are safe from the resistance. So if it breaks, it's a good sign for us. But even so, there are no $25 options, call options, by the time the session closed yesterday. And if we want to get some reasonable premium out of the shares, we have to get the risk and set and sell some puts at a very close at the strike price, very close to the current stock price, and that's why then they have only a probability of profit of 75%, which is, in my view, a bit low for what we want to do. And so this is the way we are currently standing at the moment with Pfizer, and you see that our performance is really suffering because of this. And the more shares we add to our holding, the more drag in our portfolio it is going to be. But of course I'm sharing the current situation with you guys, but there is nothing we can do. The market always knows best, or for the most part knows best. So we will going to continue with our strategy, selling puts on the Pfizer with a remainder of the cash that we have after selling our puts with in this case from the IWM. But this is getting concerning because such a large position and it basically does not move. And of course the dividends are nice, but the dividends are a very small portion of the returns that we could have with this stock. So we have to really hope that this momentum that the market is taking somehow gets also includes or makes the Pfizer shares wake up. Let's see. Basically this is it for today, and next week again most likely we are going to sell puts on the IWM. sell some puts on Pfizer as well. We're going to sell also some calls as well. This is absolutely mandatory. This is for sure the trade that we are going to do. Certainly, we are selling some calls on Pfizer even if we have to extend the maturity. But yeah, we will see. For the time being, this is all. Feel free to leave your comments in the comment section down below. And any questions you may have, feel free also to send me a DM on LinkedIn. And of course, feel free to like the video and subscribe to the channel. And on Monday, we will reconvene to see what trades did we do and to begin the week number 49 in this challenge. And I'll see you there.